Lowe's is one dividend stock down 24% that investors might regret not buying on this dip. In this video, I'll explain why I think that's the case, so stay tuned, you're not going to want to miss this. So starting with Lowe's dividend yield, a 1.58% dividend yield is not as high as a 10-year government bond might give you at close to 3.3% as of this recording. However, investors of Lowe's stock today can reasonably expect Lowe's to increase its dividend over the next several years at a healthy rate because Lowe's has been doing a good job increasing its revenue and its profits, which I will show you a little bit later in this video. Those increases in revenue and profits typically lead to increases in dividends per share. So let me show you the revenue increases. Here you have Lowe's annual revenue going back to 2014, 2013 here, and it's grown from close to $55 billion all the way up to $97 billion. The company has done an excellent job increasing revenue and capitalizing on the massive home improvement industry. You might not be aware, but every year people spend $900 billion. Well, at least last year, people spent $900 billion on home improvement, and Lowe's was the second largest home improvement company last year, right behind, well, not right behind, but considerably behind Home Depot. So the company's operating in a massive industry that's still growing, and it's consolidating market share, and it's got good defenses in its business, right? Amazon cannot encroach on Lowe's business as aggressively as it can encroach on some other brick and mortar businesses, right? Because the types of things that Lowe's sells is difficult for Amazon to sell online, or at least difficult for Amazon to sell online profitably. So Amazon will be less likely to try and enter that space because it doesn't feel confident that it can do so profitably, right? It's hard to sell the kind of things that Lowe's sells with a good profit margin on Amazon because they're heavy. Sometimes they're things that need more than one person for delivery. Sometimes there's things that people go to Lowe's for that they want right away. So waiting for 2 days to receive it from Amazon is less attractive. So for all those reasons, Lowe's has done a good job of keeping its sales and protecting its sales from encroachment by Amazon. Another thing that Lowe's has done very well over this last decade is increase its operating profit margin. We could look back here from 2013 all the way to 2022. The company was boosting its operating profit margin over the trailing 12 months. In the recent few quarters, that has dipped below a little bit. That's to be understood, right? Because the company thrived during the earlier stages of the pandemic as people were spending a lot more on home improvement. Now that's not as popular, so Lowe's sales is decelerating and profit margin is decelerating because sales have come down a little bit while the company has had to boost its wages for its employees and it's had to pay more for materials and cost of goods sold. So that is dipping a little bit. However, investors can reasonably expect this to return upward and go on this longer run trend at the company increasing its operating profit margin over time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Finally, the last reason why I think investors might regret not buying Lowe's stock on this dip here is because of the favorable valuation. Lowe's is trading at a forward price to earnings ratio of 13.25, which is near the lowest the stock has traded for according to this valuation going back about 2 years. going back about 2 years. So it's a favorable valuation, and this incorporates the fact that the company's earnings are going to be pressured over the next year as consumers spend more on away from home activities now that economies have reopened. So this is already accounting for that fact, the pressure over the next year. However, longer term, consumer spending on home improvement is likely to return to its trend line, which is growth in the high mid single digits. So something like 5 to 8% revenue growth for Lowe's, and then earnings per share growth in the low double digits, 10 to 12 to 13% is something you can reasonably expect, which is very good for a stock that's trading at a forward price to earnings of just 13.25 because of what I mentioned earlier, in that Lowe's can protect this type of growth longer term because competitors like Amazon are less likely to be able to make gains in this area. So for all of those reasons, I think that investors might regret not buying Lowe's stock on this dip right now. All right, so that's all I've got for this video. Thank you so much for watching. I've picked some videos for you that are popping up on your screen. I think you'll enjoy them. Please click one of those and I'll see you over there.